There is a certain kind of investor who seems almost boring to watch. While others chase headlines, follow hot stock tips, and react to every market movement, this investor stays calm. They research carefully, follow a system, and act only when the evidence supports a decision. This investor is not boring. This investor is disciplined. And discipline is one of the greatest advantages an investor can develop. This audiobook teaches a 9-step system for analyzing stocks before you invest. You will learn how to define your strategy, filter the market, understand a business, analyze its financial statements, measure competitive advantage, evaluate management, estimate intrinsic value, calculate a margin of safety, and make the final investment decision. The goal is not to get rich quickly. It is to understand what you are buying, why you are buying it, what it is worth, and how much protection you have if you are wrong. Most investors begin with price. They see a stock rising and want to buy it. They see a stock falling and assume it is cheap. This system begins with understanding. By the end, you will have a repeatable framework for separating strong businesses from weak ones, value from price, and rational investing from emotional speculation. 9 steps. 1 disciplined system. And it begins with the most important investment you will ever analyze. Chapter 1. Define your investment strategy. Why knowing yourself comes before knowing the stock. There is a question that almost every new investor skips, and almost every experienced investor eventually realizes they should have answered first. The question is not which stock should I buy. The question is, what kind of investor am I? This might seem like a philosophical detour before getting to the practical business of picking stocks. But it is the opposite of a detour. It is the foundation on which every good investment decision is built. Because the right investment for one person is the wrong investment for another. And understanding why requires understanding the profound differences that exist between different investors and how those differences shape every decision that follows. Let us start at the very beginning. An investment strategy is a personal document. It is a description of how you intend to approach the market based on who you are, what you own, what you owe, what you need, and what you want. It is not a generic template you download from the internet. It is not a copy of what a famous investor does. It is specific to your life, your circumstances, and your financial goals. A well-defined investment strategy answers several fundamental questions. What is your time horizon? How much risk can you genuinely tolerate? What are your return expectations? How much time can you devote to research? What types of businesses interest and excite you? What is your tax situation? What is your current financial position? Let us work through each of these questions carefully, because your answers will shape everything that comes after. Time horizon. How long will you hold? Time horizon is perhaps the most important single variable in investment strategy. It refers to how long you intend to hold your investments before you need to use the money for something else. If you are 25 years old and investing for retirement, your time horizon might be 40 years or more. If you are 60 years old and planning to retire in 5 years, your time horizon for that portion of your money is just 5 years. If you are saving for a house down payment and hope to buy in 3 years, that money has a 3-year horizon. Why does time horizon matter so much? Because time is what allows compound growth to work its magic. And because the longer your time horizon, the more short-term volatility you can absorb without it affecting your financial plan. Consider this carefully. If you own a stock that falls 30% in value over 6 months, that is a painful experience no matter who you are. But if your time horizon is 30 years, that 30% decline may turn out to be entirely irrelevant. If the underlying business continues to grow and compound, the price will eventually reflect that growth, and the temporary decline will look like a minor bump in a very long road. Many of the greatest investment returns in history came from holding great businesses through periods of significant short-term price decline. But if your time horizon is 3 years, a 30% decline becomes a serious problem because you may need that money in 3 years, which means you might be forced to sell at a depressed price rather than waiting for recovery. This is why the system taught in this audiobook is best suited for investors with time horizons of at least 5 years, and ideally 10 or more. The approach of deeply analyzing businesses, identifying competitive advantages, and buying at a discount to intrinsic value is a long-term strategy. It does not produce quick results. It produces results that compound dramatically over extended periods of time. If you need money within 2 or 3 years, that money should not be in stocks at all. It should be in stable, liquid instruments like money market funds, certificates of deposit, or short-term government bonds. Stock market investing, done properly, is a long-term activity. Please hold this truth firmly in mind as you continue. Risk tolerance, the gap between what you think and what you feel. Risk tolerance is one of the most misunderstood concepts in investing. Most people dramatically overestimate their ability to tolerate risk until the moment they are actually experiencing it. It is easy to say, in a rising market, with money in your account growing every month, that you are comfortable with high levels of risk. It is a very different experience to watch your portfolio fall 40% in value during a market crash, while the news is filled with predictions of further declines, layoffs are rising, and your friends are selling everything in panic. Risk tolerance has two components, and it is critical to understand both. The first is financial capacity for risk. This is an objective measure of how much loss you can sustain without it damaging your financial plan. If you have no debt, 6 months of living expenses saved in cash, a stable income, and a portfolio that is separate from money you need in the near term, you have high financial capacity for risk. If you have significant debt, limited savings, and money in the market that you might need within a few years, your financial capacity for risk is low, regardless of how you feel about it emotionally. The second component is emotional tolerance for risk. This is your psychological ability to remain calm and rational during periods of market decline. Some people have extraordinarily high emotional tolerance. They can watch their portfolio drop significantly in value, shrug, and continue holding their positions because they trust the underlying businesses and know that prices will recover. Other people find market declines intensely distressing. They lose sleep. They make impulsive decisions. They sell at the worst possible moments because the psychological pain of watching paper losses accumulate becomes unbearable. Neither of these personality types is better or worse. They are simply different, but they imply very different investment strategies. Here is a practical test of your emotional risk tolerance. Think about what percentage loss in your portfolio would cause you to seriously consider selling everything. If the answer is 10%, your emotional risk tolerance is low. If the answer is 25%, it is moderate. If the answer is 50% or more, and you genuinely mean it, your emotional risk tolerance is high. Most people discover, when they are actually in the middle of a major market decline, that their emotional risk tolerance is lower than they thought it was in calmer times. This is not a criticism. It is simply human nature. Loss aversion is one of the most well-documented findings in behavioral psychology. People feel the pain of losing money approximately twice as intensely as they feel the pleasure of gaining the same amount. This asymmetry in emotional experience has profound implications for investment behavior, and understanding it about yourself is the first step toward managing it effectively. The investment approach taught in this audiobook helps manage emotional risk in a very specific way. When you have done deep analysis on a business, when you understand why it is valuable, when you have studied its competitive advantages and management quality, and when you have bought it at a meaningful discount to your estimate of its intrinsic value, you have a rational basis for remaining calm during price declines. You know what you own, you know why you own it, and you know that a temporary decline in price does not necessarily mean anything has changed about the long-term value of the business. This is the psychological power of systematic analysis. It does not eliminate discomfort during downturns, but it gives you something to hold on to when emotions are running high. Return expectations. Being honest with yourself. What returns do you expect from your investments? This question seems simple, but the honest answer requires confronting some uncomfortable truths about what is actually achievable in the stock market over different time periods. The long-run historical average annual return of the broad stock market has been roughly 7 to 10% in real terms, meaning after accounting for inflation, depending on the country and the time period you examine. This compounding at 7 to 10% annually over many decades is extraordinarily powerful. A single initial investment growing at 8% annually for 30 years turns into roughly 10 times the original amount. That is genuine wealth creation. But most individual investors do not earn the market average return. Research consistently shows that the average individual investor significantly underperforms the market average over time. The reasons are well documented. Investors buy after prices have risen and sell after prices have fallen. They trade too frequently, generating unnecessary costs. They concentrate in fashionable sectors at exactly the wrong time. They allow emotions to override rational decision-making. If you aspire to match or modestly beat the market average over long periods of time through careful, systematic analysis of individual businesses, that is a realistic and worthwhile goal. If you aspire to double the market's return every year, you are setting yourself up for disappointment and likely for poor decisions driven by that unrealistic expectation. Set your return expectations honestly. Plan around conservative assumptions, and then let your systematic process do the work. If you consistently apply the 9 steps in this audiobook, select good businesses, buy at fair prices, and hold patiently, you have a genuine chance of being among the investors who beat the market average over time. But it requires patience, discipline, and realistic expectations, not the expectation of overnight riches. Time available for research. Be honest about this too. How much time can you realistically devote each week to analyzing companies and managing your investment portfolio? This matters more than many people realize. The system taught in this audiobook requires real research. Analyzing a single company properly through all 9 steps might take 10 to 20 hours of focused work the first time you do it. As you develop experience and build up a knowledge base about industries and business models, the process becomes faster. But it always requires real time. If you are a full-time professional with a family, managing a household, and balancing other responsibilities, you may have only a few hours each week to devote to investment research. That is perfectly fine. But it has implications for how many stocks you can analyze and monitor at any given time. It suggests keeping your portfolio concentrated in a smaller number of well-understood businesses rather than spreading across dozens of companies you cannot possibly keep up with. If you are a retiree with substantial free time, or if investing is your profession, you may be able to devote much more time to research. That allows a wider field of analysis and potentially a larger portfolio of well-understood positions. Be honest with yourself about this. The biggest mistakes in stock analysis often come not from lack of intelligence, but from overreach. From trying to follow too many companies, spreading attention too thin, and ending up with shallow knowledge of many things rather than deep knowledge of a few things. Deep knowledge is what this system requires and what this system rewards. Areas of interest and expertise. Your competitive edge. Here is something that professional investment managers rarely talk about publicly, but that great individual investors understand intuitively. You have competitive advantages that even the largest investment firms do not have. You have real-world experience and expertise in specific industries. You work in a specific field, buy specific products, observe specific businesses in your daily life. You have knowledge about what products are good and which are overrated. You know which companies are genuinely excellent to work with and which frustrate their customers. You understand the competitive dynamics of your industry in ways that an analyst sitting in a financial district office building can never fully grasp from reading reports. Peter Lynch, one of the greatest mutual fund managers in history, called this phenomenon investing in what you know. He argued persuasively that individual investors have a genuine edge in understanding businesses that operate in their everyday lives, precisely because they interact with those businesses as customers, employees, suppliers, or competitors. If you work in healthcare, you may have insights about pharmaceutical companies, medical device manufacturers, or hospital chains that are not fully captured in analyst reports. If you work in technology, you may understand the competitive dynamics of software platforms, cloud services, or semiconductor companies in ways that give you genuine analytical edge. If you are a retailer, you understand what makes a retail concept work and what makes it fail in ways that go beyond what you can read in a quarterly earnings report. This does not mean you should only invest in industries you work in, but it does mean that your areas of genuine knowledge and interest are worth taking seriously as a source of investment ideas. Start with what you know. Build outward from there. And always be aware of the difference between areas where you have real insight and areas where you are simply guessing. Defining your investment style: value, growth, or something else. Once you have thought carefully about your time horizon, risk tolerance, return expectations, available time, and areas of expertise, you need to make one more foundational decision. You need to define your investment style. There are several primary styles of long-term stock investing, and while this audiobook is firmly rooted in the value-oriented tradition of fundamental analysis, it is worth understanding the landscape. Value investing, in its purest form, is the practice of buying stocks at prices below their intrinsic worth. The value investor believes that markets are periodically irrational, that the price of a stock sometimes diverges significantly from the underlying value of the business, and that by carefully estimating intrinsic value and buying at a discount, one can earn superior returns over time while taking less risk than the average investor. This approach was pioneered by Benjamin Graham and refined by many great investors who came after him. Growth investing is the practice of seeking out companies that are growing revenues and earnings rapidly, often paying premium prices in the expectation that continued high growth will justify those prices over time. Growth investors tend to focus less on current earnings or dividends and more on future potential. The risk is that if growth slows or fails to materialize, expensive prices can lead to dramatic losses. The most sophisticated practitioners of modern fundamental investing often blend these two styles, looking for companies with strong growth prospects that are also trading at reasonable valuations relative to their current or near-term earnings power. This blend, sometimes called growth at a reasonable price, is arguably the most practical and enduring approach to long-term stock selection. This audiobook teaches a framework that is most naturally aligned with this blended approach. It asks you to find good businesses with durable competitive advantages, run by capable management, and buy them when they are available at prices that provide a genuine margin of safety. Whether the businesses are growing rapidly or more slowly matters less than whether they are excellent, understandable, and available at sensible prices. Writing your investment policy statement. Here is a practical exercise that separates serious investors from casual ones. Write down your investment strategy, not in your head, on paper, or in a document, in clear, specific language that you could read back to yourself in the middle of a market panic and find both useful and grounding. Your investment policy statement does not need to be long. It might be a single page, but it should clearly state your time horizon, your risk tolerance, and how you define it. your return expectations, the types of businesses you are looking to own, the criteria that must be met before you will invest, and the conditions under which you will sell. This document serves a crucial psychological function. When markets are panicking and your portfolio is falling in value, you will be under enormous emotional pressure to do something, to react, to act decisively. In those moments, having a written policy statement that you have committed to in advance gives you something to anchor to. It reminds you of the reasoning that led to your investments in calmer, clearer moments. It protects you from making impulsive decisions that violate your own best judgment. Successful investing is, in large part, about making good decisions in advance and then having the discipline to stick to those decisions when it becomes emotionally difficult to do so. Your investment policy statement is the tool that makes this possible. How Chapter 1 connects to everything that follows. Everything in the remaining 8 chapters of this system flows directly from the foundation you lay in Chapter 1. Your time horizon determines what kinds of businesses are appropriate for you. A long time horizon allows you to invest in businesses that are currently unprofitable but have outstanding long-term potential. A shorter time horizon pushes you toward businesses with proven, stable earnings that you can be confident will still be there in 5 years. Your risk tolerance determines how concentrated your portfolio should be and how much volatility you are willing to accept in exchange for higher potential returns. Lower risk tolerance suggests broader diversification and more defensive businesses. Higher risk tolerance may allow you to concentrate in fewer, higher conviction positions. Your return expectations determine how strictly you apply your valuation criteria in Chapter 7 and Chapter 8. If you need very high returns to meet your financial goals, you need to be more disciplined about buying at significant discounts to intrinsic value. If your goals are more modest, you may be able to pay somewhat higher prices for businesses of exceptional quality. Your available time for research determines how many companies you can realistically follow, which in turn determines the breadth of your watch list and the depth of your portfolio. Your areas of expertise influence which industries you prioritize in Chapter 2 when you are filtering the market for opportunities. And your investment style determines the overall character of your portfolio, whether it leans toward stable, dividend-paying businesses or toward higher growth companies that reinvest their earnings aggressively. All of this starts with you, with your honest self-assessment, with your clearly defined strategy, before you ever look at a single company. This is why Step 1 is Step 1, not because it is the most exciting part of the process, but because, without a solid foundation here, every step that follows is built on sand. With a solid foundation here, everything else has a clear structure and a clear purpose. Take the time to define your investment strategy carefully. Write it down. Revisit it periodically, because your circumstances will change and your strategy should evolve with them. But always have a clear, honest, written answer to the question, what kind of investor am I? That question, honestly answered, is the beginning of every great investment decision you will ever make. Chapter 2. Filter the market. Narrowing the universe without missing the stars. Now that you have defined your investment strategy, you face a practical challenge that stops many aspiring investors in their tracks before they even begin. The challenge is this. There are tens of thousands of publicly traded companies across global stock markets. You cannot study all of them. You cannot even study a fraction of them with the kind of depth this system requires. So how do you decide where to focus your attention? The answer is filtering. Systematic, disciplined filtering of the investment universe to identify a manageable set of companies worth studying seriously. This is Step 2 of the 9-step system, and it is far more important than it might initially seem. Filtering is not about finding the perfect company immediately. It is about eliminating the vast majority of companies that, for clearly defined reasons, do not meet your criteria. Think of it as a funnel. You pour the entire market into the top of the funnel, wide and chaotic. What comes out the bottom, after passing through your filters, is a small set of serious candidates worth investing your research time in. And from that set, your deeper analysis in steps 3 through 9 will identify the actual investments worth making. Poor filters waste your most valuable resource, which is your analytical time. If you spend 30 hours studying a company and only discover at the end that it has characteristics that should have eliminated it immediately, you have spent 30 hours poorly. Good filters prevent this. They quickly and efficiently narrow your attention to the companies that have the highest potential for meeting all 9 of your criteria. Let us walk through the most important categories of filters that a fundamental investor should apply when scanning the market for candidates. Filter 1. Business model understandability. The first filter is also the most subjective, and it is this: do you understand how this company makes money? This is not a trick question. It is a profound and practical one. Peter Lynch used to say that he would never invest in any idea he could not illustrate with a crayon. Warren Buffett talks about his circle of competence, the set of businesses and industries he understands well enough to make reliable predictions about their future earnings power. Both of these legendary investors are making the same point. Understanding is the prerequisite of all good investing. If you cannot clearly explain, in plain language, how a company earns its revenue, what its costs are, who its customers are, what makes those customers keep coming back, and what could cause those customers to leave, then you do not understand the business well enough to invest in it confidently. This filter will automatically eliminate many categories of companies for most investors. Highly complex financial institutions with enormous derivative books may be difficult for most people to understand deeply. Early-stage biotechnology companies, whose value depends on clinical trial outcomes, may require specialized scientific knowledge to evaluate properly. Companies operating in highly regulated industries in foreign countries may involve legal and political complexities beyond most investors' expertise. None of this means these are bad investments. It simply means that if they are outside your circle of competence, they fail your first filter. Someone else, with the appropriate background, might analyze them brilliantly. But if you cannot understand them well enough to be confident in your analysis, move on. There are plenty of understandable businesses in the world. Filter 2. Business quality indicators. The second filter involves a quick assessment of business quality using a small number of widely available metrics. These are not the deep financial analysis you will do in Chapter 4. They are quick preliminary screens to identify companies that appear to have the basic characteristics of a high-quality business. The first quality indicator to examine is return on equity. Return on equity measures how effectively a company generates profit from the money shareholders have invested in it. It is calculated by dividing net income by total shareholder equity. A consistently high return on equity, generally above 15% annually over multiple years, suggests that the business is genuinely efficient at turning shareholder capital into profits. It suggests a business with some degree of pricing power and competitive strength. Look for companies that have maintained high returns on equity consistently over many years, not just in 1 or 2 exceptional years. The second quality indicator is return on invested capital. This is a more comprehensive measure than return on equity because it includes debt in the calculation of the capital base. It measures how effectively a company generates profit from all the capital it has deployed, including both equity and borrowed funds. A high and consistent return on invested capital, again generally above 15%, is one of the most reliable signals of business quality. Companies that consistently earn high returns on invested capital are typically doing something that competitors find difficult to replicate. The third quality indicator is profit margin consistency. Examine the gross profit margin and operating profit margin over the past 5 to 10 years. Are these margins stable or improving? or are they declining and being squeezed by competition or rising costs? Companies with stable or expanding margins are generally operating in favorable, competitive environments. Companies with persistently declining margins are usually fighting an uphill battle. The fourth quality indicator is revenue growth. Not all revenue growth is created equal. You want to see organic revenue growth, meaning growth that comes from the business genuinely selling more products or services, not primarily from acquisitions or accounting adjustments. Look for companies that have grown revenues consistently over multiple years, not just in boom times. The rate of growth matters less than the consistency and the quality of that growth. These quality indicators together give you a quick picture of whether a business has the fundamental characteristics worth studying more deeply. They are not definitive. A company might fail some of these metrics for good reasons that a deeper analysis would reveal. But as a first screen, they are powerful and efficient. Filter 3. Financial health and debt load. The third filter examines financial health, particularly the level and structure of the company's debt. Debt is a powerful tool. Used wisely, it can amplify the returns of an already excellent business. Used unwisely, it can take an otherwise good business and make it fragile, vulnerable to any economic downturn or business disruption. At the filtering stage, you are looking for companies whose debt levels are manageable relative to their earnings power. A common measure is the ratio of total debt to earnings before interest, taxes, depreciation, and amortization, commonly abbreviated as debt, to a form of operating earnings. For most businesses, a ratio below 3 is generally considered manageable. Above 5 begins to raise serious concern. Above 8 is in territory that most fundamental investors would avoid, absent very specific and compelling circumstances. Also, examine the structure of the debt. How much of it is due in the near term? A company with heavy debt maturities, coming due in the next 2 years, may face significant refinancing risk if credit conditions tighten. Long-term, fixed-rate debt is generally less dangerous than short-term or variable-rate debt. Look also at the interest coverage ratio, which measures how many times a company's operating earnings cover its interest payments. Higher coverage means the company is comfortably able to service its debt from normal operations. Low or declining coverage is a warning sign. This filter should eliminate companies that are carrying dangerous levels of debt, not because debt is inherently bad, but because excessive debt changes the risk profile of an investment dramatically. A company with excessive debt can see its equity become worthless even if the underlying business remains moderately healthy, because creditors have a legal prior claim on the company's assets before equity holders receive anything. Filter 4. Management ownership and alignment. The fourth filter looks at whether the people running the company have meaningful skin in the game. Management ownership matters for a straightforward reason. Executives and directors who own significant amounts of their company's stock are personally motivated to make decisions that serve the long-term interests of shareholders, because they are shareholders themselves. Executives who own little stock and rely entirely on salary and bonus compensation may be motivated to manage for short-term metrics that maximize their compensation, even if those decisions are not in the best long-term interest of the business or its owners. This filter does not require that founders still be running the company, though that is often a positive sign. It requires that the current management team has a meaningful personal financial stake in the business. Examine the proxy statement, which is a document companies file annually with stock market regulators and which discloses executive compensation, board composition, and insider ownership levels. Look for executives who own stock worth several times their annual salary, ideally much more. Also, look at recent insider transactions. Have executives been buying stock in the open market with their own money? That is a meaningful positive signal. Have they been selling large portions of their holdings? That is worth examining carefully. though insider sales are not always negative, since executives sell for many reasons, including tax planning, diversification, and personal expenses. The combination of meaningful ownership and recent buying provides a strong first-pass signal that management is genuinely aligned with outside shareholders. Filter 5. Sector and industry fit. The fifth filter is about fit, meaning how well the company aligns with your own investment criteria, expertise, and preferences, as defined in Chapter 1. Some investors prefer capital-light businesses, companies that can grow without requiring large ongoing investments in physical assets. Technology platforms, service businesses, and certain consumer brands often fall into this category. Their ability to grow revenues without proportional growth in capital expenditure makes them particularly attractive from a return on capital perspective. Other investors prefer asset-heavy businesses in industries they understand well, such as manufacturing, real estate, or natural resources. These businesses have different economic characteristics, but can also produce excellent investment returns when bought at the right price. Some investors have strong ethical preferences that lead them to avoid certain industries entirely. These preferences are valid and should be part of your investment strategy definition. If you are unwilling to own tobacco companies, defense contractors, or businesses in certain other industries for ethical reasons, then those categories simply do not pass your filter, and that is completely acceptable. The goal is to build a portfolio you are comfortable holding through any market environment. If certain types of businesses make you uncomfortable, you should not own them, regardless of their financial metrics. The sector and industry filter is also where your personal expertise becomes most relevant. If you work in retail, you may have genuine insight into which retail models are truly differentiated and which are commoditizing. If you work in healthcare, you may have a superior ability to evaluate the competitive positioning of medical companies. Lean into these advantages. Start with industries where you have real knowledge and expand cautiously from there as you develop expertise in new areas. Filter 6. Market capitalization and liquidity. The sixth filter considers the size of the company and the ease with which you can buy and sell its shares. Market capitalization, the total value of all shares outstanding, is a useful first indicator of a company's scale and the risks associated with investing in it. Very large companies, often called large cap or mega cap stocks, tend to be more thoroughly analyzed by professional investors. This means they are less likely to be significantly mispriced, but also means any genuine mispricing you identify may represent a real opportunity that others have missed. Smaller companies are analyzed by fewer professionals and may offer more opportunities for a careful individual investor to find mispriced situations. However, they also come with greater risks, including less financial stability, more dependence on a small number of customers or products, and the possibility that their securities may be harder to buy or sell in large quantities without affecting the price. For most individual investors, there is no need to operate in the smallest market capitalization stocks. Companies with market capitalizations above $500 million are generally liquid enough to buy and sell comfortably, and the universe of such companies is still extremely large. Liquidity refers to how easily you can buy or sell shares without significantly affecting the price. For most individual investors, liquidity is rarely a significant concern because the amounts being invested are small relative to daily trading volume in most stocks. But if you are investing larger sums, or if you are considering very small companies, liquidity deserves attention. The Watchlist, your curated pool of candidates. The output of your filtering process is a watchlist, a curated list of companies that have passed all of your first-pass filters and are worth studying more deeply. Your watchlist is not a buy list. Being on the watchlist does not mean you should immediately purchase a stock. It means the company has cleared a meaningful set of initial hurdles and deserves the more intensive research described in steps 3 through 9. A well-maintained watch list is one of the most valuable assets a fundamental investor can build. Over time, as you study more companies and develop your knowledge of various industries and business models, your watch list becomes a rich database of high-quality businesses that you understand well. When market conditions produce temporary price declines, your watch list allows you to move quickly and confidently because you have already done the work of understanding these businesses. How many companies should be on your watch list? This depends on how much time you have for research. As a general rule, most individual investors can meaningfully follow and update their analysis on 20 to 50 companies at a time. More than that tends to dilute attention below the level of quality required for confident decision-making. Your watch list should be a living document. Companies move on and off it as their situations change. A company that fails a filter today might become highly interesting in 2 years if management changes, if the balance sheet improves, or if the business model evolves. Stay curious, stay open, and keep refining your pool of candidates continuously. Screening tools. Using technology effectively. One practical note about how to identify candidates for your watch list in the first place. Financial screening tools make the filtering process dramatically more efficient. Most major brokerage platforms provide screening tools that allow you to filter the entire market by financial metrics, including return on equity, profit margins, debt levels, market capitalization, revenue growth rates, and dozens of other variables. These tools allow you to quickly identify companies that meet your quantitative criteria, producing a starting list of candidates without requiring you to manually examine thousands of individual companies. However, use screening tools as a starting point, not an ending point. Screens are powerful but limited. They capture what can be measured numerically and miss many of the most important qualitative factors that determine investment quality. A company might pass every quantitative screen beautifully while having a management team that is quietly destroying value through poor capital allocation decisions. Another company might fail a quantitative screen because it had a temporary earnings decline that distorts the numbers, when in fact, the business is fundamentally excellent. Use screens to generate a list of candidates. Then apply your qualitative judgment, your understanding of industries and business models, and your reading of management character to refine that list into a genuine watch list of companies worth serious study. Building filters that match your strategy. A critical point about filtering is that your filters should be specifically designed to match the investment strategy you defined in Chapter 1. If you defined yourself as a long-term investor with high risk tolerance and a preference for high-growth businesses, your filters should be calibrated accordingly. You might accept higher debt levels in businesses with exceptional growth trajectories. You might be willing to look at companies with no current earnings if the growth opportunity is compelling enough. If you defined yourself as a conservative investor with low risk tolerance and a preference for stable, dividend-paying businesses, your filters should screen for long dividend payment histories, stable earnings, moderate debt, and sectors known for resilience during economic downturns. There is no one-size-fits-all set of filters. The filters are tools, and like all tools, they are most effective when they are matched to the specific job being done. The real value of disciplined filtering. Let us step back and appreciate what disciplined filtering actually accomplishes, because its value goes beyond simply saving time. When you have applied clear, consistent filters to the universe of stocks and identified a watch list of genuine high-quality candidates, you have done something powerful. You have eliminated the noise. You have removed from your field of attention the hundreds of poorly managed, financially fragile, or fundamentally uninteresting companies that make up the bulk of the investment universe. You are now operating in a much smaller, much higher quality space where your deeper analysis will be more productive and your eventual investment decisions will be on firmer ground. This is the discipline that separates the systematic investor from the impulsive one. The impulsive investor reacts to headlines, chases momentum, and buys whatever is currently exciting. The systematic investor applies filters, builds a watch list, and only acts within that carefully curated universe of companies they have already determined to be worth serious attention. Your filters are the first line of defense against poor investments. Not the last line, but the first. They prevent you from wasting your most valuable resources, your time, and your analytical energy on companies that have no business being in your portfolio. With your watch list established, you are ready to move to the next level of analysis. The companies on your watch list have passed your filters. Now, it is time to truly understand what they do and how they do it. Chapter 3. Study the business model. Understanding what you own before you count what it earns. There is a temptation, particularly for analytically minded people, to skip straight to the numbers. Financial statements are concrete, numerical, and seem to offer objective truth. They feel scientific. Analyzing them feels rigorous. Studying the business model, by contrast, feels qualitative and imprecise, more like reading than analysis. Resist this temptation completely. The numbers in a financial statement are not self-explanatory. They only make sense in the context of the business that generated them. A revenue growth rate of 15% tells you very little until you understand why the company is growing, whether that growth is sustainable, and what it is costing the company to achieve it. A profit margin of 30% tells you something impressive has happened, but not whether that margin can be defended against competitive pressure. A high level of capital expenditure tells you nothing until you understand whether those investments are building a stronger business or simply maintaining a deteriorating one. Business model analysis is what gives the numbers meaning. It is the lens through which all financial data must be interpreted. And it is step 3 of the 9-step system for very good reason. What is a business model? Exactly. A business model is the description of how a company creates value, delivers it to customers, and captures a portion of that value as profit. Those 3 elements, creation of value, delivery of value, and capture of profit, are all essential. A business that creates tremendous value for customers but cannot capture any of it, as profit is not a great business from an investor's perspective. A business that captures profit but does not genuinely create value for customers will eventually lose those customers. A business that creates and captures value but cannot efficiently deliver it at scale faces inherent limitations on growth. The best businesses do all 3 things exceptionally well. They create products or services that customers genuinely need or want. They deliver those products or services in ways that are hard to replicate. And they do so in a way that generates consistent, growing profits for their owners. Understanding a business model requires answering several specific questions in detail. Let us work through each of them. What product or service does the company provide? This seems obvious, but the depth of your answer to this question reveals how well you actually understand the business. Most people can name what a company sells, but the serious investor needs to understand why customers buy it, what need it fulfills, how important that need is to the customer, and whether the product or service is truly differentiated or largely commoditized. Consider a company that sells coffee. On the surface, coffee is coffee. It is a commodity product available from dozens of sources. But certain coffee businesses have built products and brands and experiences around their coffee that create genuine differentiation. Customers are willing to pay significant premiums for these differentiated products, not just because of the physical coffee itself, but because of the entire experience associated with the brand. The product is not simply coffee. The product is a combination of taste, atmosphere, brand identity, convenience, and social signaling. When you study a company's products or services, go beyond the surface description. Ask what the customer is actually buying when they choose this company over its competitors. Ask what would happen if this company raised its prices by 10%. Would customers stay or leave? That answer tells you something profound about the business. Who are the customers, and how does the company reach them? Customer analysis is one of the most important and underappreciated aspects of business model study. Begin with the basics. Who are the customers? Are they individual consumers buying for personal use? Are they small businesses, large corporations, government agencies? The nature of the customer base has profound implications for the business model. Consumer-facing businesses often have the advantage of brand power and emotional connection. Customers can develop genuine loyalty to consumer brands in ways that are difficult to measure financially, but extremely powerful competitively. Think of the customer who would never consider switching their preferred brand of athletic shoes, even if a competitor offered a virtually identical product at a lower price. That loyalty is a form of competitive advantage that shows up in pricing power and margin stability. Business-to-business companies often have the advantage of deeper customer relationships, longer contract periods, and higher switching costs. A company that supplies critical software to a large corporation may be embedded so deeply in that corporation's operations that switching to a competitor would be enormously expensive and disruptive. This switching cost creates a form of customer captivity that is enormously valuable. After identifying who the customers are, examine how the company reaches them. What are the distribution channels? Does the company sell directly to customers or through intermediaries? How much of the company's revenue comes from new customer acquisition versus repeat business from existing customers? This last question is particularly important. Businesses with high proportions of repeat, recurring revenue from loyal existing customers are generally far more valuable and predictable than businesses that must constantly win new customers. A business where 70% of revenue comes from customers who have been buying for 5 years or more is in a very different and usually better position than a business where most revenue comes from new customers each year. How does the company make money? The revenue model. There are many different ways that companies generate revenue, and understanding the specific revenue model of a company you are studying is essential. Some companies sell products outright for a one-time payment. This transactional model is straightforward, but creates revenue unpredictability, since the company must continually find new customers or persuade existing customers to buy again. Other companies generate recurring revenue through subscriptions, service agreements, or long-term contracts. Subscription businesses have a predictability advantage because they begin each year with a known base of revenue from customers who are already paying and have committed to continue paying. This makes financial planning and forecasting much easier and more reliable. Some companies charge based on usage, meaning customers pay only for what they consume. This model can grow rapidly as customer usage expands, but introduces volatility because usage can also decline during economic downturns. Some companies earn revenue through transactions between third parties, taking a small percentage of each transaction they facilitate. Marketplace businesses and payment processors often work this way. They scale beautifully when transaction volumes grow, but are exposed to competitive pressure on the transaction fee itself. Some companies earn revenue through licensing intellectual property, collecting royalties from other companies that use their patents, brands, or technology. These models can be extraordinarily high margin and capital light. Understanding which of these revenue models applies to the company you are studying, and often companies use multiple models simultaneously, tells you a great deal about the predictability, scalability, and quality of the company's earnings. What are the key cost drivers? Every business has costs. Understanding the structure and nature of those costs is essential to understanding the economics of the business. Some businesses have predominantly fixed costs, meaning costs that remain relatively stable regardless of how much revenue the company generates. A company with high fixed costs and low variable costs typically exhibits significant operating leverage. As revenue grows, A large portion of each additional dollar of revenue falls to the bottom line as profit because the fixed costs are already covered. This can produce spectacular earnings growth during periods of revenue expansion. However, fixed cost structures can be dangerous during revenue contractions because the costs remain even as revenue falls. Other businesses have predominantly variable costs, meaning costs that rise and fall roughly in proportion to revenue. These businesses have less operating leverage, meaning earnings do not grow as dramatically during revenue expansions, but they are also more resilient during downturns because costs naturally decline as revenue does. Labor is typically the largest cost for service businesses. The ability to scale labor efficiently as the business grows is a critical factor in the business model's economics. Companies that can grow revenue faster than labor costs are moving in the right direction. Companies where labor costs consistently grow faster than revenue are heading toward margin compression. Cost of goods sold, often abbreviated as COGS, is the direct cost of producing whatever the company sells. Gross profit margin, which is revenue minus cost of goods sold divided by revenue, is one of the most informative numbers in all of financial analysis. A high and stable gross profit margin suggests that the company has pricing power and that the underlying business economics are favorable. A low or declining gross margin suggests competitive pressure or rising input costs that the company cannot fully pass on to customers. What is the company's competitive moat? First look. At this stage in the analysis, you are getting your first look at the question that will occupy an entire chapter later in this audiobook, the question of competitive advantage. But even at the business model study stage, you should be forming preliminary impressions. What protects this business from competition? Why do customers choose this company rather than an alternative? What would happen if a well-capitalized competitor entered this market tomorrow and aggressively competed on price? How would this company respond, and how long could it maintain its position? These questions at the business model stage are not meant to be fully answered yet. That comes in Chapter 5. But they are important to begin thinking about because they shape how you read every other piece of information about the company. A business model analysis without any sense of competitive dynamics is incomplete. How scalable is the business? Scalability refers to a business's ability to grow revenue significantly without proportional increases in costs. Highly scalable businesses, such as software platforms, digital content providers, or financial exchanges, can often double or triple their revenues while adding only a fraction of that revenue growth in additional costs. This produces enormous leverage and allows profits to grow much faster than revenues. Less scalable businesses, such as service companies that must hire proportionally more people as they grow, or manufacturing businesses that must build expensive new facilities to increase capacity, require more capital and operational complexity to grow. This does not make them bad businesses, but it does limit the potential returns on capital that they can achieve at scale. Understanding the scalability of a business model tells you how the economics of the business will change as it grows. It tells you whether the best years are ahead or whether growth will become increasingly expensive and difficult over time. What risks threaten the business model? Every business model has vulnerabilities. Part of studying the business model is honestly cataloging these risks. Technological disruption is one of the most common and dramatic risks to existing business models. Entire industries have been transformed or destroyed by technological change. Businesses built on physical media were disrupted by digital distribution. Traditional retailers were disrupted by e-commerce. Traditional media was disrupted by social platforms and streaming services. Ask honestly whether the business you are studying is vulnerable to the kind of technological disruption that has derailed similar businesses. Regulatory risk is significant for businesses in heavily regulated industries such as healthcare, financial services, utilities, and certain consumer products. A regulatory change can fundamentally alter the economics of a business almost overnight. Understanding the regulatory environment in which a company operates and how changes in that environment might affect the business model is essential. Customer concentration risk is the danger that too large a portion of revenue comes from a single customer or a small group of customers. If one customer represents 30% of a company's revenue, the loss of that customer would be devastating. Examine the customer concentration of any business you are studying and evaluate whether that concentration represents a meaningful risk. Supplier concentration risk is the mirror image. If a company depends on a single supplier for a critical input, that supplier has significant leverage, and the company is vulnerable to supply disruptions or price increases. Macroeconomic sensitivity is the degree to which the business's revenues and earnings vary with overall economic conditions. Some businesses are highly cyclical, meaning their performance rises sharply during economic booms and falls sharply during recessions. Others are more defensive, maintaining relatively stable revenues regardless of the economic environment. Understanding where your company falls on this spectrum is important for knowing what to expect during different phases of the economic cycle. Reading annual reports and investor presentations. The primary sources of information for business model analysis are the company's own communications to shareholders. The annual report, particularly the sections written by management rather than audited by accountants, is an invaluable source of insight. The letter to shareholders that appears at the front of most annual reports, particularly in companies run by owner-oriented management, often contains extraordinary insight into how management thinks about the business, what they are trying to accomplish, and what they see as the most important challenges and opportunities ahead. Read these letters carefully, not just for the content, but for the tone, the honesty, and the quality of thinking they reveal. The business description section of the annual report, which regulatory filings typically require companies to provide in significant detail, contains formal descriptions of the company's products and services, its markets, its competition, and its business model. This section is denser and more legalistic than the shareholder letter, but it contains essential factual information about how the business operates. Investor presentations and earnings call transcripts provide additional perspectives on how management communicates about the business. Pay attention to what management chooses to emphasize and what they seem to downplay or avoid. Pay attention to how they handle difficult questions. Their responses under pressure often reveal more about management character than polished presentations do. Synthesizing your business model understanding. After your business model study, you should be able to write, in plain language, a clear description of the company's business model that covers all of the elements discussed above. Who the customers are, what need the company fulfills, how it reaches those customers, how it generates revenue, what its key costs are, what protects it from competition, how scalable it is, and what risks threaten it. If you cannot write this description clearly and confidently, you need more study before proceeding. The discipline of forcing yourself to articulate your understanding in plain language is one of the most powerful analytical tools available. If your written description is vague, full of jargon, or dependent on assumptions you cannot explain, your understanding is not yet sufficient. When your description is clear, specific, and grounded in evidence, you are ready to move to the next step, which is to examine the numbers that reflect the performance of the business you now understand. The financial statements await, and they will tell you whether the business model that looks so good on paper has actually been producing real value in practice. Chapter 4. Analyze financial statements. Reading the story behind the numbers. Financial statements are the language in which businesses communicate their economic reality to the outside world. They are not perfect. They are not completely objective. They are not always easy to interpret, but they are the most comprehensive and standardized source of factual information available about a company's financial performance and position, and a serious investor must be able to read them with genuine skill. This chapter is going to teach you how to approach the three primary financial statements: the income statement, the balance sheet, and the cash flow statement, in a way that reveals the true economic character of the business you are studying. We are not going to turn this into an accounting textbook. We are going to focus on what matters most for investment decision-making. Begin with this framing. Financial statements tell a story. The story of how the business performed over a specific period of time, what resources it currently controls, and how cash flowed through the organization. Your job is to read that story critically and accurately, to identify what the numbers are telling you and what they might be hiding. Let us work through each statement carefully. The income statement, how the business performed. The income statement, also called the profit and loss statement or the statement of operations, reports the company's revenues, costs, and profits over a specific period of time, typically a quarter or a year. Start at the top. Revenue is the total amount of money the company received from customers in exchange for its products or services during the period. Revenue growth is one of the most important indicators of business health. A business that is consistently growing revenue is generally one that is expanding its market presence, growing its customer base, or deepening its relationship with existing customers. Flat or declining revenue raises serious questions about the health of the business. But not all revenue growth is equal. Growth, driven by genuine increases in the volume of products or services sold, or by justified price increases, is healthy. Growth driven by aggressive discounting that trades margin for volume may be damaging the long-term economics of the business. Growth driven by acquisitions may or may not create value, depending on how much was paid and how well the acquired businesses are integrated. Understanding the source and quality of revenue growth is as important as the number itself. Below revenue, you find the cost of goods sold. This is the direct cost of producing whatever the company sold. Subtracting cost of goods sold from revenue gives you gross profit, and dividing gross profit by revenue gives you gross margin. As noted earlier, gross margin is one of the most revealing numbers in all of financial analysis. A high and stable gross margin suggests that the company has pricing power, that it is not simply competing on price, and that the basic economics of its business model are favorable. Compare the gross margin of the company you are studying to its competitors and to the historical average for its industry. A gross margin that is significantly higher than the industry average is a strong early signal of competitive advantage. A gross margin that has been declining over multiple years is a warning sign that competition is intensifying or that input costs are rising faster than the company can manage. Below gross profit, you find operating expenses, which include costs like sales and marketing, research and development, and general and administrative expenses. Subtracting operating expenses from gross profit gives you operating income, also called earnings before interest and taxes. Operating income divided by revenue gives you the operating profit margin. The operating margin tells you how efficiently the company is converting its gross profit into real operating earnings. A high and expanding operating margin suggests that the company is scaling efficiently and that its cost structure is well managed. A declining operating margin, even if gross margin is stable, suggests that operating expenses are growing faster than revenue, which often indicates either an investment phase the company is making to support future growth or a cost control problem that management is failing to address. Below operating income, you find interest expense on debt and then taxes. After these deductions, you reach net income, which is the profit attributable to shareholders after all costs, including financing and taxes. Earnings per share, calculated by dividing net income by the number of shares outstanding, is one of the most widely watched metrics in investing. Be careful with earnings per share analysis. Because companies can reduce the number of shares outstanding by repurchasing shares, earnings per share can grow even when total net income is flat. This is not inherently deceptive. Share repurchases can be an excellent use of capital when done at the right price. But it is important to distinguish between earnings growth that comes from genuine business growth and earnings per share growth that comes from share count reduction. Also, be very cautious about non-recurring items in the income statement. Companies frequently report one-time gains or charges that affect net income in a given period, but do not reflect the ongoing earning power of the business. A company that reports a large gain from selling a piece of real estate looks profitable in that year's numbers, but that gain tells you nothing about what the business will earn next year. Similarly, a large restructuring charge might make the current year's earnings look terrible while representing an investment that will improve future earnings. Always look beyond the headline net income number to understand what is driving it. The balance sheet, a snapshot of financial position. The balance sheet provides a snapshot of what the company owns, what it owes, and the difference between the two, which belongs to shareholders at a specific point in time. Assets are listed on one side of the balance sheet. They represent everything of value that the company controls, from cash and inventory to equipment, real estate, and intangible assets like patents and brand value. Liabilities are listed on the other side. They represent everything the company owes to others, including accounts payable to suppliers, loans from banks, bonds outstanding, and other financial obligations. The difference between total assets and total liabilities is shareholders' equity, also called book value. This represents the theoretical residual value belonging to shareholders if all assets were sold and all liabilities were paid off. When analyzing the balance sheet, start with liquidity. Does the company have adequate cash and liquid assets to meet its near-term obligations? The current ratio, which divides current assets by current liabilities, gives a quick read on this. A ratio above 1 suggests that the company can cover its short-term obligations from its short-term assets. A ratio below 1 suggests potential liquidity stress. Next, examine the debt structure in detail. How much total debt does the company carry? What are the terms, maturity dates, and interest rates on that debt? Is the debt at fixed rates, protecting the company from rising interest costs, or at variable rates, exposing the company to interest rate risk? Pay close attention to goodwill and intangible assets, which appear on the balance sheet as the result of acquisitions. When a company acquires another business, it often pays more than the book value of the target's net assets. The excess payment is recorded as goodwill on the acquiring company's balance sheet. Large amounts of goodwill can be a warning sign, not necessarily of fraud, but of the risk that overpaid acquisitions will eventually require painful write-downs that reduce book value and earnings. The return on equity analysis you began in your filtering step is directly connected to the balance sheet. Return on equity measures how efficiently the company is generating profit from the shareholder equity on the balance sheet. A high return on equity suggests that the business requires relatively little capital to generate significant profits. A low return on equity suggests either poor profitability relative to the capital deployed or a capital-intensive business model. The cash flow statement, the truth teller. If the income statement is where companies can most creatively manage their reported results through accounting choices, the cash flow statement is where the truth is harder to hide. That is why many sophisticated investors consider the cash flow statement the most important of the three financial statements. The cash flow statement reports the actual movement of cash into and out of the company during a period. It has three sections: operating cash flow, investing cash flow, and financing cash flow. Operating cash flow reports the cash generated by the company's core business operations. This is the amount of cash that came through the door from customers, minus the cash paid to suppliers, employees, and other operating costs. Consistently positive and growing operating cash flow is the lifeblood of a healthy business. Compare operating cash flow to net income over multiple years. They should generally be in the same direction and of roughly similar magnitude over time, though they will rarely be identical in any single year due to working capital changes and non-cash items. If operating cash flow is consistently significantly below net income, it is a warning signal. It suggests that the company is reporting profits that are not being converted into actual cash. The most common cause is aggressive revenue recognition or other accounting choices that inflate reported earnings beyond the cash reality. Investing cash flow reports the cash spent on or received from investments in long-term assets, primarily capital expenditure to maintain and expand the business, and acquisitions or divestitures of other companies. Capital expenditure is critically important to understand. It represents the cash the company must invest just to maintain its existing operations, plus any additional investment to grow. A particularly powerful concept is free cash flow, which is operating cash flow minus capital expenditure. Free cash flow represents the cash that the business generates after maintaining its asset base, which is available to distribute to shareholders, reduce debt, or reinvest in growth opportunities. Consistently strong free cash flow is one of the most powerful indicators of investment quality. A business that generates abundant free cash flow has options. A business that chronically consumes cash has constraints. Compare free cash flow to net income over multiple years. If free cash flow is consistently close to net income or above it, the company's earnings are of high quality, meaning they are backed by real cash. If free cash flow is consistently well below net income, the earnings quality is lower, and you should understand why. Financing cash flow reports the cash flows related to debt and equity financing, including borrowing and repaying debt, issuing or repurchasing shares, and paying dividends. A company that is consistently raising new debt or issuing new shares to fund its operations is not self-sustaining from a cash perspective. A company that is repaying debt and repurchasing shares from the cash generated by its operations is in excellent financial health. Analyzing trends. 5 to 10 years of history. One of the most important principles of financial statement analysis is to look at long time periods, ideally 5 to 10 years of annual data. A single year of financial data tells you very little. It might be an exceptional year, for better or worse. It might not represent the normal earning power of the business at all. Looking at 5 to 10 years of data allows you to see trends, to identify whether profitability is growing or declining, whether capital efficiency is improving or deteriorating, and whether the company's financial position is strengthening or weakening over time. Build a simple table of the key metrics over as many years as data is available. Revenue, gross margin, operating margin, net income, operating cash flow, free cash flow, total debt, and return on equity. Look at how these numbers have changed over time. Are the trends positive, stable, or negative? Has the company maintained its margins through economic cycles, or did they collapse during downturns? Has return on equity been consistently high, or is it volatile? Consistency is one of the most underrated virtues in financial analysis. A company that produces stable, predictable, growing results year after year is often more valuable than one that produces spectacular results in some years and terrible results in others. Consistency indicates a resilient business model, good management, and a favorable competitive environment. Volatility, even around a high average, introduces risk and makes valuation more difficult. Comparative analysis. Benchmarking against the industry. Financial ratios only make complete sense in the context of comparison. Compare every important metric to the company's own historical performance and to the performance of its direct competitors and industry peers. A gross margin of 40% is exceptional in some industries and mediocre in others. A debt-to-earnings ratio of 3 might be conservative for a utility company with predictable cash flows and concerning for a cyclical industrial company whose earnings can swing dramatically. A return on equity of 20% might be outstanding for a manufacturer and merely average for a software company. The industry context matters enormously. Always know what the normal economic characteristics of the industry are before evaluating any individual company within it. Looking at competitors in parallel also helps you identify what is company-specific versus what is industry-wide. If all companies in an industry are seeing declining margins, the problem may be structural in the industry itself. If one company's margins are declining while competitors are stable or rising, the problem is specific to that company and its management or competitive positioning. Warning signs in financial statements. Financial analysis is partly about finding things to be excited about and partly about finding warning signs that might indicate trouble. Here are some of the most important red flags to watch for. Revenue recognition that is inconsistent with cash flow. If reported revenues are growing strongly, but the cash received from customers is growing much more slowly, or if accounts receivable is growing much faster than revenues, it may indicate that the company is booking revenue prematurely or aggressively. Consistently capitalizing costs that should be expensed. Some companies stretch accounting rules by capitalizing costs that should be expensed in the current period, making current earnings look better than they truly are. This is detectable by comparing the company's capitalization policies to industry norms. Frequent and large one-time charges. One-time charges occasionally are a normal part of business. But a company that reports significant one-time charges almost every year, claiming each is exceptional, is essentially restructuring its business annually in a way that should make investors very suspicious. These charges are often management's way of managing perceptions about the ongoing earning power of the business. Inconsistent accounting policies. Changes in accounting methods, while sometimes legitimate and disclosed in the financial statement notes, can also be used to make results look better. Watch for companies that frequently change how they account for revenue, inventory, or other items. Off-balance sheet commitments. In the footnotes of financial statements, you will often find information about financial commitments that do not appear directly on the balance sheet, such as long-term operating leases, purchase commitments, or guarantee obligations. These can significantly affect the true financial position of the company and deserve careful attention. Building your financial summary. After completing your financial statement analysis, compile a clear summary of your findings. This summary should document the key metrics for the past 5 to 10 years, the trends you have identified, how the company compares to its peers, and any warning signs you have noted. This summary becomes part of the investment thesis file you are building for each company on your watch list. It is the foundation for the valuation work you will do in Chapter 7, and it provides the context for the competitive advantage and management analysis in Chapters 5 and 6. Financial analysis is a skill that improves dramatically with practice. The more financial statements you read, the faster you recognize patterns, the quicker you spot anomalies, and the more accurately you develop intuition about the financial health of a business. Do not be discouraged if the first several financial statements you analyze feel overwhelming. Stay patient, work through them systematically, and trust that the pattern recognition will develop over time. With your financial analysis complete, you are halfway through the 9-step system. And the next 3 chapters are going to take your analysis from the quantitative to the qualitative, examining the qualities that make a business truly exceptional rather than merely financially adequate. Chapter 5. Measure competitive advantage. The difference between a good business and a great one. If you had to identify the single concept that most distinguishes the greatest investors in history from the merely competent ones, it would be this. The greatest investors are obsessed with competitive advantage, not just whether a company is currently profitable, not just whether it is growing revenues, not just whether its stock is attractively priced, but whether the business has the kind of durable, defensible, structural advantage over its competitors that will allow it to continue generating superior returns on capital for many years, or even many decades, into the future. This concept is so central to long-term investing that Warren Buffett gave it a memorable name. He calls it the economic moat. Just as a medieval castle was protected from invaders by the moat surrounding it, a great business is protected from competitive attack by its economic moat. The deeper and wider the moat, the more secure the castle. The more durable and powerful the competitive advantage, the more secure the business's profitability. A business without a moat is like a castle without a moat. Open, vulnerable, constantly under assault. Any competitor with sufficient capital can enter its market, undercut its prices, and erode its profitability. A business with a wide moat is protected. Competitors can try to attack it, but the structural advantages the moated business possesses make it extremely difficult for them to succeed. This chapter is going to teach you how to identify, measure, and assess the strength and durability of economic moats. Why competitive advantage matters for long-term returns. Let us start with a thought experiment. Consider two businesses. Business A earns a return on invested capital of 25%, but it has no significant competitive advantage. Its products are undifferentiated from competitors. There are no meaningful barriers to entry, and customers have no reason to prefer it over alternatives other than price. When competitors see that Business A is earning high returns, they enter the market, compete aggressively on price, and within 5 years, the return on invested capital has been driven down to the industry average of 8%. Business B also earns a return on invested capital of 25%, but it has a powerful, competitive advantage in the form of a beloved consumer brand, massive economies of scale, and a distribution network that would cost competitors billions of dollars to replicate. Competitors look at Business B's profits and want to compete, but the barriers are too formidable. 10 years later, Business B is still earning 25% returns on invested capital, and the business is worth dramatically more than it was a decade ago. Both businesses looked equally attractive by their current financial metrics. Only one was genuinely great, and the difference was entirely in the durability and width of the competitive moat. This is why competitive advantage analysis is not optional. It is essential. Without it, you cannot distinguish between a temporarily profitable business that will eventually be competed away and a genuinely great business that will compound wealth for decades. The 5 primary sources of economic moat. Research and experience have identified 5 primary categories of competitive advantage that create durable economic moats. Let us examine each one carefully. The first, and perhaps most familiar, is brand power. A great brand represents something more than a logo or a name. It represents a set of beliefs, associations, emotions, and expectations that customers reliably attach to a product or service. When those associations are powerful enough, customers become genuinely reluctant to switch to alternatives, even when alternatives are functionally equivalent or even somewhat superior. Brand power creates pricing power, which is the ability to charge more than competitors for essentially similar products or services without losing customers. Companies with powerful brands can often maintain prices significantly above those of generic or less recognized alternatives. This pricing power directly protects and expands profit margins over time. But not all brands create moats. A brand that customers recognize is not the same as a brand that customers are genuinely attached to and willing to pay a premium for. Test brand power by asking whether customers would actively choose this brand over alternatives, even at a meaningful price premium. If the answer is yes, reliably and consistently, you may be looking at a genuine brand moat. The second source of moat is switching costs. Switching costs are the financial, operational, or psychological costs that customers incur when they switch from one supplier's product or service to a competitor's. When switching costs are high, customers tend to remain loyal, not because they love the product, but because the cost of changing is greater than the benefit they would gain from switching. Software companies often have extremely high switching costs. A large corporation that has built its operations around a particular enterprise software platform may find that switching to a competitor would require retraining thousands of employees, migrating enormous amounts of data, rebuilding integrations with dozens of other systems, and accepting months of disruption and reduced productivity. Even if the competitor's product is superior in some ways, the switching cost makes staying with the current provider the rational choice in most circumstances. Financial services companies, healthcare providers, and industrial equipment manufacturers often also benefit from significant switching costs. Any company whose products or services become deeply embedded in the operations of its customers, making extraction genuinely costly and disruptive, has a powerful form of competitive advantage. The third source of moat is network effects. Network effects occur when a product or service becomes more valuable to each user as more users adopt it. This creates a self-reinforcing dynamic where early scale advantages translate into permanent competitive advantages. The classic example is a telephone network. A single telephone is useless. Two telephones allow one call. A billion telephones connect everyone. The more people who have telephones, the more valuable the telephone network becomes to each user. This is the network effect in its purest form. Modern examples abound in digital platforms. Social media networks become more valuable as more people join them. Payment networks become more valuable to merchants as more cardholders use them. Operating systems become more valuable as more software is built for them, and more software is built for them because more people use them. Marketplace platforms become more valuable to buyers as more sellers join, and more valuable to sellers as more buyers join. Network effects are among the most powerful forms of competitive advantage because they create a winner-take-most dynamic. Once a network achieves critical mass, it can be extremely difficult for newcomers to dislodge it, because the newcomer must somehow convince users to leave the large, established network for the small, new one. This gives leading platforms extraordinary durability. The fourth source of moat is cost advantages. Some companies have structural cost advantages that allow them to produce goods or services more cheaply than any competitor. These cost advantages come from several different sources. Scale economies are the most common. A company that is significantly larger than its competitors can often spread its fixed costs over a much larger revenue base, giving it a lower cost per unit. This advantage grows as the company gets larger, creating a self-reinforcing dynamic where scale produces cost advantage, and cost advantage allows competitive pricing that drives further scale. Proprietary process advantages occur when a company has developed manufacturing processes, supply chain relationships, or operational capabilities that allow it to produce its products at lower costs than competitors, regardless of scale. These advantages are often the result of years of operational learning and innovation and are difficult for competitors to replicate quickly. Proprietary resource access gives some companies access to inputs that competitors cannot easily obtain. A mining company that owns a rich, easily accessible deposit of a valuable mineral has a cost advantage over competitors who must mine from poorer or more expensive deposits. A media company that owns irreplaceable content libraries has a content cost advantage over competitors who must produce or acquire expensive new content. The fifth source of moat is regulatory and legal barriers. In some industries, regulation creates barriers to entry that make competition extraordinarily difficult. Pharmaceutical companies, with patents protecting their drugs from generic competition, enjoy a legally enforced monopoly for the patent period. Utilities that have exclusive licenses to serve specific geographic territories face no competition within those territories. Banks require expensive and lengthy regulatory approval processes to establish, which limits new competitive entry. Regulatory moats are powerful while they last, but can be vulnerable to regulatory change. A drug patent eventually expires. A regulatory environment can shift. Legal moats require ongoing attention to ensure they remain intact. How to assess moat width and durability. Identifying that a moat exists is only half the work. You also need to assess how wide and how durable it is. These are distinct questions. Width refers to how large and sustainable the competitive advantage is at the current moment. A company with an extraordinarily powerful brand, high switching costs, and network effects all simultaneously has a very wide moat. A company with only a modest cost advantage has a narrower moat. Durability refers to how likely the moat is to remain intact over the next 5 to 15 years. This is where honest assessment of competitive threats, technological change, and regulatory risk becomes critical. A moat that currently appears very wide might be vulnerable to narrowing due to technological disruption, regulatory change, or a resourceful new competitor. To assess durability, ask the following questions. Is the moat based on a source of advantage that could be disrupted by technological change? Is the regulatory protection the moat relies on at risk of being removed? Are there well-capitalized competitors actively investing in eroding the moat? Is the consumer behavior that underlies the moat stable or shifting? The most durable moats are typically those based on deep consumer habits, high switching costs rooted in deeply embedded products, network effects in large established platforms, and significant scale advantages in industries with stable technology. The least durable are those based on rapidly evolving technology, easily transferable know-how, or regulatory protection in politically unstable environments. Moat trends, widening or narrowing. Perhaps the most important assessment you can make about a moat is whether it is widening or narrowing over time. A business with a widening moat is a business where the competitive advantage is growing stronger over time. Perhaps the brand is becoming more powerful. Perhaps the network is getting larger and the network effects are deepening. Perhaps scale advantages are expanding as the company grows. This widening trend is enormously valuable because it means that not only is the current business excellent, but it is likely to become even more excellent in the future. A business with a narrowing moat is a business where the competitive advantage is eroding. Perhaps a new technology is making the product less relevant. Perhaps a well-capitalized competitor is investing heavily to match the company's capabilities. Perhaps regulatory protection is being phased out. This narrowing trend is dangerous because it means that the business's future will likely be less attractive than its past. When you find evidence that a moat is narrowing, be very cautious about investing, even if the current financials look attractive. Current profitability that is about to be competed away may be misleading as a guide to future earnings power. The market often does not immediately recognize moat deterioration, which can make a narrowing moat business look attractively priced even as its intrinsic value is declining. Quantifying competitive advantage. Return on invested capital as the scorecard. While competitive advantage analysis is qualitative in nature, it has quantitative consequences that you can measure. The most important of these is return on invested capital. A business with a genuine competitive advantage should consistently earn returns on invested capital that significantly exceed its cost of capital. If a business's cost of capital is approximately 10% and it consistently earns returns on invested capital of 20% or more, it is creating substantial value for its shareholders. If it earns returns at or below its cost of capital, it is destroying value, regardless of whether revenues are growing. Track return on invested capital over a decade or more. A great business with a durable moat should show consistently high returns over the entire period, through economic cycles, through competitive challenges, and through industry changes. Occasional dips during recessions are normal, but sustained high returns over long periods are the quantitative fingerprint of genuine competitive advantage. Compare the company's return on invested capital to that of its competitors. If one company consistently earns significantly higher returns than competitors in the same industry, that premium is the financial evidence of a competitive moat. It shows that the company has something its competitors do not, and that this something is allowing it to deploy capital more profitably than anyone else in its space. Competitive advantage and intrinsic value. The connection between competitive advantage and intrinsic value is profound and direct. A business with a wide, durable moat is worth more than an identical business without a moat for a very specific reason. When you estimate the intrinsic value of a business, you are essentially estimating the present value of all the cash that business will generate in the future. For a business without a moat, competition will eventually drive returns on capital toward the cost of capital, which means the business will not be creating surplus value for its owners. For a business with a wide, durable moat, above-average returns on capital can persist for many years or decades into the future. Each of those future years of above-average returns contributes additional intrinsic value. This is why great businesses with wide moats can justify much higher valuations than mediocre businesses with no moats. The market is not just paying for current earnings. It is paying for the expectation of how long above-average returns will persist. The wider and more durable the moat, the longer those above-average returns should persist, and the higher the justified valuation. Understanding this connection is essential for the valuation work you will do in Chapter 7. A business with a narrow or uncertain moat should be valued conservatively because you cannot confidently forecast sustained above-average returns. A business with a wide, durable moat can be valued more generously because the probability of sustained exceptional returns over many years is much higher. With your competitive advantage assessment complete, you now have a clear picture of whether the business you are studying has the structural characteristics to be not just a good investment, but a great one. The next question is whether the people running this business are worthy of the franchise they have been entrusted with. Chapter 6. Evaluate Management, the Human Factor in Business Excellence. Great businesses are built by great people, and great businesses can be destroyed by poor ones. This is one of the most important truths in all of investing, and yet it is often the most underappreciated aspect of investment analysis. Investors spend enormous time and energy analyzing financial metrics and competitive dynamics. They spend comparatively little time genuinely evaluating the character, capability, and incentive structure of the people running the businesses they own. This is a mistake, because even the most extraordinary business franchise can be damaged or destroyed by management that lacks integrity, strategic judgment, or capital allocation discipline. And even a moderately positioned business can be transformed into an exceptional one by visionary management that consistently makes excellent decisions over long periods of time. Chapter 6 of this system is dedicated to the systematic evaluation of management, not a surface-level review of executive biographies. A deep, evidence-based assessment of who these people are, how they think, and whether they are genuinely aligned with the interests of the shareholders who have entrusted capital to them. The 3 pillars of management evaluation. Evaluating management requires examining 3 distinct dimensions. The first is integrity. The second is competence. The third is capital allocation skill. Great management requires all 3. Weakness in any one of them is disqualifying for serious long-term investment. Let us examine each dimension carefully. Integrity, the non-negotiable foundation. Integrity is the most important quality in management and, unfortunately, the most difficult to assess from the outside. You cannot sit down with a CEO and ask them directly if they are honest. Obviously, any dishonest CEO would claim to be completely honest. You must evaluate integrity through evidence, through the consistency between what management says and what management does over multiple years and multiple business cycles. Start by reading every letter to shareholders, every earnings call transcript, and every major management presentation you can find from the past 5 to 10 years. What did management say would happen? Did those things actually happen? When results were poor, did management take responsibility honestly, or did they blame external factors? When results were strong, did management give a realistic assessment of risks and challenges ahead, or did they simply celebrate the good news? Great managers are characterized by a particular kind of honesty that is rare in corporate communications. They report bad news with the same directness they report good news. They discuss the weaknesses of their business alongside its strengths. They acknowledge mistakes openly and describe what they are doing differently. They give shareholders a realistic picture of the competitive landscape, including the genuine threats the business faces. Poor managers, and there are many, do the opposite. They minimize bad news. They blame external factors for disappointing results while claiming personal credit for positive ones. They use language that is vague and optimistic rather than specific and realistic. They project confidence about the future that is not supported by any clear explanation of what actions will produce the promised outcomes. One of the most revealing tests of management integrity is how they handle a crisis. When business conditions deteriorate significantly, how does management communicate? Do they get out ahead of problems, warning shareholders early and providing specific plans? Or do they continue issuing optimistic guidance until circumstances force them to acknowledge reality? Managers who communicate honestly in difficult times, who take ownership of failures and provide credible plans for improvement, are demonstrating exactly the kind of integrity that long-term shareholders need and deserve. Pay attention also to executive compensation structures. How are the executives paid? Are bonuses tied to metrics that genuinely reflect long-term value creation, such as multi-year returns on capital and free cash flow growth? Or are they tied to short-term metrics like quarterly earnings per share that can be manipulated through accounting choices, or to revenue growth that may not be profitable? Incentive structures reveal what management cares about. Pay attention to what they are incentivized to optimize for, because they will. Look also at related party transactions disclosed in the proxy statement. Are executives doing business with their own companies in ways that could create conflicts of interest? Are they awarding contracts to companies they personally own, or paying for services from businesses controlled by family members? Any transactions that appear designed to benefit management personally at the expense of shareholders are serious integrity red flags. Competence, the ability to execute. Integrity without competence is merely well-intentioned failure. The second pillar of management evaluation is an assessment of strategic and operational capability. Begin by examining the track record. What strategic decisions has management made over the past 5 to 10 years, and how have they worked out? Did the company enter new markets that proved successful? Did it exit businesses that were destroying value? Did it make acquisitions that created genuine value for shareholders? Or did it make expensive acquisitions that looked impressive but ultimately failed to generate adequate returns? The acquisition track record is particularly revealing. Acquisitions are high-stakes decisions that test both analytical competence and the discipline to avoid overpaying. Research consistently shows that most corporate acquisitions destroy value for the acquirer's shareholders. The acquired company is typically purchased at a significant premium to its market price. The deal often comes with integration costs, management distraction, and cultural challenges that reduce rather than enhance the combined organization's effectiveness. Great acquirers, by contrast, have a clear acquisition strategy, pay disciplined prices, execute integrations effectively, and can demonstrate through subsequent financial results that the acquisitions they made were genuinely value-creating. Look for this pattern. Management teams that have a history of disciplined, value-creating acquisitions are demonstrating exactly the kind of strategic and analytical competence that long-term investors want. Look also at how management has navigated competitive threats. Has the company successfully adapted its business model in response to technological change or new competitors? Has it invested ahead of the market in capabilities that prove to be genuinely important? Or has it been slow to respond to threats, clung to existing business models that were becoming obsolete, or made reactive decisions after being surprised by competitors? The competitive response track record tells you a great deal about how management thinks, how quickly they gather and act on information about their competitive environment, and how willing they are to make difficult decisions to reposition the business when necessary. Also, evaluate the depth and stability of the management team. Is the CEO surrounded by a strong team of executives who complement their skills? Is there evidence of thoughtful succession planning? High rates of executive turnover, particularly at the senior level, can be a warning sign of cultural problems or strategic uncertainty. Stable, experienced management teams that work together effectively over many years are typically a significant positive. Capital allocation, the highest order skill. The third pillar is perhaps the most underappreciated by non-professional investors. Capital allocation skill is the ability to deploy the cash and capital resources of the business in ways that maximize long-term value for shareholders. Every year, a profitable business generates earnings. Management must decide what to do with those earnings. The options include reinvesting in the existing business through organic capital expenditure, acquiring other businesses, returning cash to shareholders through dividends, repurchasing the company's own shares, or paying down debt. Each of these choices has different implications for long-term shareholder value, depending on the circumstances. The best capital allocators are highly selective and highly disciplined. They reinvest in the existing business aggressively when and only when they can clearly demonstrate that those investments will generate returns that exceed the cost of capital. They make acquisitions only when they can find genuinely good businesses at genuinely fair prices, and they are willing to walk away from acquisitions that do not meet this standard, no matter how much strategic logic appears to support them. They return cash to shareholders when internal investment opportunities are less attractive, doing so through whichever vehicle, dividends or buybacks, is most advantageous in the specific circumstances. Particularly revealing is the company's stock repurchase history. Share repurchases are a powerful value creation tool when done at the right price. When a company repurchases its own shares at prices below intrinsic value, it effectively increases the per-share ownership of remaining shareholders in a business worth more than what was paid. But repurchases at prices above intrinsic value destroy value, transferring wealth from long-term shareholders to those who sold their shares. Look at the timing and pricing of the company's historical repurchases. Has management repurchased shares when they were attractively priced and held back when they were expensive? Or has the company followed the opposite pattern, buying back stock aggressively during boom times when prices are high and stopping or reversing repurchases during downturns when prices might offer genuine bargains? The former is evidence of excellent capital allocation discipline. The latter is evidence of following the crowd rather than thinking independently about value. Dividend policy is also revealing. Management that maintains or grows dividends through difficult times is demonstrating confidence in the ongoing cash generation of the business. Management that cuts dividends unexpectedly, particularly when they had previously assured shareholders the dividend was safe, is demonstrating either poor forecasting or, more concerningly, poor communication. Reading between the lines. Tone and communication style. Beyond the formal analysis of track record and incentives, there is a qualitative dimension to management evaluation that is harder to systematize, but no less important. It is the assessment of how management thinks and communicates, the quality of their reasoning, and the intellectual honesty they bring to their public statements. Read shareholder letters carefully for the quality of thinking they reveal. The best management teams write with clarity, specificity, and genuine insight about their business, its competitive position, and the challenges it faces. They use plain language rather than jargon. They acknowledge uncertainty honestly rather than projecting false confidence. They explain their reasoning in a way that allows you to evaluate whether it is sound. Great shareholder letters read like genuine attempts to inform and educate long-term partners. Poor shareholder letters read like marketing documents, full of impressive-sounding language about the company's strengths and opportunities, while carefully avoiding any specific discussion of risks, weaknesses, or competitive challenges. Similarly, review how executives handle difficult questions on earnings calls. When analysts ask probing questions about business challenges or disappointing results, do management respond with clear, direct, specific answers? Or do they deflect, use vague language, or pivot to unrelated positive talking points? The ability and willingness to answer hard questions directly is a reliable indicator of intellectual honesty and genuine confidence in the business. Building your management assessment. After completing your management evaluation, you should have clear positions on 3 questions. Do you trust these people with your money? Are they demonstrably competent at running and growing this type of business? Do they have the capital allocation discipline and skill to make excellent decisions with the cash flows the business generates? If the answer to all 3 is a confident yes, you have found management that deserves to be part of your long-term investment thesis. If there is meaningful doubt on any of the 3 dimensions, proceed with significant caution. Management risk is one of the most common and most painful reasons that otherwise good investment theses fail. And now, with a deep understanding of the business, its financial history, its competitive advantages, and the quality of the people running it, you are fully prepared to tackle the most technically demanding and intellectually satisfying part of the investment analysis process. It is time to estimate what this business is actually worth. Chapter 7. Estimate intrinsic value. Finding the true worth of a business. We have arrived at the question that sits at the absolute center of fundamental investing. What is this business actually worth? Not what the market currently says it is worth. Not what it was worth last year. Not what some analyst projects it will be worth next year. What is its genuine, underlying, business-derived value, independent of market sentiment, independent of price trends, independent of what anyone is currently willing to pay for it? This is the concept of intrinsic value, and estimating it accurately, or at least approximately, is the foundation of the entire value investing tradition. Without a sense of intrinsic value, you are flying blind. You cannot know whether the current market price is high, low, or roughly fair. You cannot know when the market is offering you a genuine bargain. You cannot know when the market is asking you to pay too much. You have no anchor, no reference point, no rational basis for any specific investment decision. With a well-reasoned estimate of intrinsic value, you have a compass. You know the rough direction even when the market's noise is loudest. You have a standard against which to measure the current price and make rational, defensible decisions about whether to buy, hold, or sell. Let us begin with the most important point about intrinsic value estimation. Precision is not the goal. Reasonableness is. Embracing approximate estimation. This may feel counterintuitive to analytically minded people who are accustomed to seeking precise answers. In mathematics, an answer that is approximately right is usually wrong. In valuation, an answer that is precisely wrong is far more dangerous than one that is approximately right. Here is what that means in practice. You will never know the exact intrinsic value of any business. No one does. The future is uncertain. Revenue growth rates will not turn out exactly as projected. Margins will shift in ways that cannot be perfectly anticipated. Discount rates are themselves estimates. Any specific number that comes out of a valuation model is not the truth. It is a reasoned estimate based on assumptions that may prove correct or incorrect. But you do not need to know exact intrinsic value. You need to know whether the current market price is significantly above, significantly below, or roughly in line with a reasonable estimate of intrinsic value. This is an achievable objective, and it is the relevant one for making investment decisions. Think of it the way Warren Buffett describes it. When you look at a person, you cannot tell exactly how much they weigh. But if you are asked whether they are overweight or underweight, you can usually give a pretty confident answer without ever getting near a scale. Intrinsic value estimation works similarly. You do not need to know whether a business is worth $42 or $47 per share. You need to know whether it is worth significantly more or significantly less than the $100 per share at which it is currently trading. The foundation: earnings power and growth. Intrinsic value derives from one thing ultimately: the cash the business will generate for its owners over its remaining useful life. This principle, though simple to state, requires careful unpacking. Let us work through it systematically. A business generates cash for its owners through its operations. After paying all its costs, after maintaining its asset base, after paying taxes and interest on debt, the remaining cash flow belongs to the owners. This is free cash flow, which you analyzed carefully in Chapter 4. The sum of all future free cash flows, adjusted to reflect the fact that a dollar received in the future is worth less than a dollar received today, is the theoretical intrinsic value of the business. This adjustment for the time value of money is called discounting, and the rate at which you discount future cash flows, called the discount rate, is typically based on the minimum return you require from your investment, which should reflect both the riskiness of the business and your opportunity cost, meaning what you could earn by deploying the capital in an alternative investment. The challenge, of course, is that future cash flows are unknown. You must estimate them, and the quality of your intrinsic value estimate depends entirely on the quality of your assumptions about future cash flow growth. Approach 1: discounted cash flow analysis. The most theoretically complete method of estimating intrinsic value is discounted cash flow analysis. This approach attempts to explicitly project the company's free cash flows over a specific forecast period, estimate a terminal value representing the value of all cash flows beyond that forecast period, and discount everything back to a present value using an appropriate discount rate. Let us walk through the steps of a basic discounted cash flow analysis. Step 1 is to establish a baseline for current free cash flow. Use the normalized, average free cash flow from the past 3 to 5 years, rather than any single year's figure, since any single year may be unrepresentative. If the business has been growing, you might use the most recent year or take a multi-year average that reflects the current scale of the business. Step 2 is to project free cash flow over a forecast period, typically 5 to 10 years. This projection should be grounded in your analysis of the business model, competitive advantage, and historical growth rates. What growth rate can this business reasonably sustain over the next 5 to 10 years? Grounding this in evidence rather than optimism is critical. Overly optimistic growth assumptions are the most common source of overvaluation errors. Step 3 is to estimate a terminal value, representing the value of all cash flows beyond the forecast period. The most common approach is to assume the business will grow at a modest, sustainable, long-term rate, often tied to the long-run growth rate of the broader economy, perhaps 2 to 3% annually in real terms, and to calculate the value of that perpetual growing stream of cash. Step 4 is to select a discount rate. This is often the most contentious element of discounted cash flow analysis. The theoretical correct discount rate is the weighted average cost of capital, which blends the cost of equity and the after-tax cost of debt in proportion to their weights in the capital structure. For most purposes, using a discount rate between 8 and 12% is reasonable for most businesses. Higher discount rates are appropriate for riskier businesses with uncertain cash flows. Lower discount rates might be appropriate for exceptionally stable, low-risk businesses with highly predictable cash flows. Step 5 is to calculate the present value of all projected cash flows and the terminal value. Add these together to get the total enterprise value of the business. Subtract net debt to get equity value. Divide by shares outstanding to get intrinsic value per share. This sounds precise, and it can be done precisely in a spreadsheet. But remember the point made earlier. The precision is illusory. What you are doing is running a reasonable, well-grounded scenario. The output is not a fact. It is an estimate that depends on assumptions, many of which will prove at least partially wrong. The most productive use of discounted cash flow analysis is not to derive a single point estimate and treat it as truth. It is to run multiple scenarios with different growth rate and margin assumptions to understand the range of outcomes and the key sensitivities. How much does the intrinsic value change if the growth rate is 3 percentage points lower than your base case? How much does it change if margins decline by 2 percentage points? These sensitivity analyses reveal the key drivers of value and help you understand which assumptions you need to be most confident about. Approach 2. Earnings-based multiples. A simpler and often more intuitive approach to intrinsic value estimation uses earnings-based multiples. Rather than explicitly projecting all future cash flows, this approach asks the question, at what earnings multiple would a rational, long-term investor willingly own this business, given its growth rate, competitive position, and risk characteristics? The most common multiple is the price-to-earnings ratio, which compares the market price per share to the earnings per share. A business with a price 10 times earnings has a price-to-earnings ratio of 10. A business with a price 40 times earnings has a price-to-earnings ratio of 40. What is a fair price-to-earnings ratio for any specific business? This depends on several factors. Growth rate is the most important. Businesses that are growing earnings rapidly can justify higher price-to-earnings ratios because investors are not just paying for current earnings, they are paying for the much higher future earnings the company is expected to generate. Quality and durability of the business matter as well. A business with a wide moat and highly predictable earnings can justify a higher multiple than one with a narrow moat and volatile earnings, because the probability that the current earnings level will be maintained and grown is higher. As a rough heuristic, a business growing earnings at 5% annually might fairly be valued at 15 to 20 times earnings. A business growing at 10% might justify 25 to 30 times earnings. A business growing at 15% or more with a wide moat might justify 30 to 40 times earnings or higher in certain conditions. These are not precise formulas. They are reasonable starting points that must be adjusted for the specific circumstances of the business you are analyzing. One critical refinement. Use normalized earnings, not the most recent year's earnings, as the basis for your multiple calculation. If a cyclical business had an exceptionally good year, its current earnings may be well above normal. Applying a standard multiple to abnormally high earnings will massively overstate intrinsic value. Similarly, if the most recent year was unusually poor due to a temporary disruption, current earnings may be well below normal, and the business may be more valuable than a simple current earnings multiple would suggest. Approach 3. Asset-based valuation. For some types of businesses, particularly holding companies, financial institutions, real estate companies, or businesses with very large tangible asset bases, an asset-based valuation approach may be more appropriate than earnings-based approaches. Asset-based valuation involves estimating the current fair market value of all the assets the business owns, subtracting all liabilities, and arriving at a net asset value per share. For businesses whose value is primarily derived from the assets they hold rather than from their ongoing earning power, this approach can give a more direct estimate of intrinsic value than earnings-based methods. Real estate investment trusts, for example, are often valued based on estimates of the fair market value of the real estate they own, adjusted for the leverage they have employed. Investment holding companies like Berkshire Hathaway are sometimes analyzed by estimating the fair value of each of the companies and investments they hold. Insurance companies are often valued based on their adjusted book value, with adjustments for the embedded value of their investment portfolio and underwriting franchise. Developing your range estimate. Rather than producing a single point estimate of intrinsic value, produce a range. Define a conservative scenario based on the more pessimistic, plausible assumptions about growth and margins. Define a base scenario based on the most likely assumptions. Define an optimistic scenario based on the more positive, plausible assumptions. Your intrinsic value range runs from your conservative scenario estimate to your optimistic scenario estimate, with the base scenario somewhere in the middle. This range is your honest estimate of the uncertainty in your analysis. A wide range indicates high uncertainty about the business's future. A narrow range indicates greater confidence in your projections. High-quality businesses with stable and predictable cash flows and wide moats tend to have narrower intrinsic value ranges. Cyclical businesses, early-stage growth companies, and businesses operating in rapidly changing competitive environments tend to have wider ranges. This range becomes your reference point for the final two steps of the system. In Chapter 8, you will use this range to calculate your margin of safety. And in Chapter 9, you will use everything you have learned to make your final investment decision. You now know what the business is worth, approximately and honestly. The next question is whether the market is offering you a good price. Chapter 8. Calculate your margin of safety, protecting your capital before protecting your returns. If you were to distill the entire tradition of intelligent investing down to a single concept, the concept of margin of safety would be the best candidate. It is the idea that when you buy a stock, you should only do so at a price that provides meaningful protection against the inevitable uncertainty in your analysis. The concept was articulated most precisely by Benjamin Graham, widely considered the father of value investing. Graham recognized something fundamental about human knowledge and prediction. We are all, without exception, limited in our ability to foresee the future accurately. No matter how thorough our research, no matter how careful our analysis, we will sometimes be wrong about the businesses we invest in. Revenues will disappoint. Margins will be squeezed by unexpected competition. A key product will fail. Management will make a costly mistake. The economy will turn against the business in ways we did not anticipate. Margin of safety is the protection against these errors. By only buying when the price is significantly below your estimate of intrinsic value, you give yourself a cushion. If you are wrong by 20% in your intrinsic value estimate, a stock you bought at a 30% discount to intrinsic value may still be purchased at or below actual value. Your error was absorbed by the margin of safety. Without margin of safety, every valuation error is a loss. With margin of safety, modest valuation errors can be absorbed without significant damage to your returns. The relationship between price and value. Before we can calculate a margin of safety, we need to firmly establish a concept that sounds obvious but has profound practical implications. Price and value are not the same thing. Price is what the stock market currently says the company is worth. It is determined, moment to moment, by the aggregate buying and selling decisions of all market participants, from large institutions managing billions of dollars to individual retail investors making their first investment. This price reflects all sorts of things: current enthusiasm or pessimism about the company, broad market sentiment, macroeconomic fears and hopes, and investor behaviors that have nothing to do with the underlying business at all. Value is what the business is actually worth, based on the cash flows it will generate for its owners over time. This is what you estimated in Chapter 7. Value changes slowly, driven by the fundamental performance of the business. Price changes constantly, driven by market psychology as much as by fundamental reality. The gap between price and value, when it exists, is your opportunity as an investor. When price is significantly above value, the stock is overvalued. Buying an overvalued stock, even a great business, is a poor investment decision because you are paying too much for the future earnings you will receive. When price is significantly below value, the stock is undervalued. Buying an undervalued stock provides both the protection of margin of safety and the opportunity for returns as the price eventually converges toward the true value. The great insight of value investing is that markets regularly create these gaps between price and value. Not because markets are stupid, because markets are composed of human beings who are subject to fear, greed, impatience, and herd behavior. These psychological tendencies cause prices to swing above and below genuine value on a regular basis, creating recurring opportunities for the disciplined investor who has done the work to know what things are actually worth. What margin of safety is not. It is important to be clear about what margin of safety is not, because the concept is sometimes misunderstood in ways that lead to poor investment decisions. Margin of safety is not simply buying cheap stocks. A stock trading at 5 times earnings is not necessarily a bargain if the business is in secular decline and those earnings are about to fall sharply. True margin of safety requires that the underlying business is genuinely valuable, that your analysis of that value is grounded and reasonable, and that the current price is significantly below that assessed value. Margin of safety is also not a guarantee against loss. Even a large margin of safety cannot protect you completely if your estimate of intrinsic value is profoundly wrong. If the business deteriorates dramatically from what your analysis suggested, or if market sentiment remains irrationally pessimistic for many years, keeping the price depressed long after you expected it to recover. What margin of safety does is reduce the probability of permanent loss and improve the expected returns over time. It is a risk management concept as much as a return enhancement concept. And risk management, in investing, is ultimately what separates the strategies that compound wealth over decades from the strategies that eventually blow up. How to calculate margin of safety. Calculating your margin of safety is straightforward once you have your intrinsic value estimate from Chapter 7. Take your conservative estimate of intrinsic value, which you derived as the lower end of your intrinsic value range. This conservative estimate is the appropriate basis for margin of safety calculation because it already accounts for the pessimistic scenario in your analysis. Using the conservative estimate rather than the base or optimistic estimate is itself a form of conservatism. Then compare this conservative intrinsic value estimate to the current market price. Margin of safety equals your conservative intrinsic value estimate minus the current price divided by your conservative intrinsic value estimate, expressed as a percentage. For example, if your conservative intrinsic value estimate is $100 per share and the current market price is $70 per share, your margin of safety is 30%. If the current price is $80, your margin of safety is 20%. If the current price is $110, you have a negative margin of safety, meaning the stock is trading above even your conservative intrinsic value estimate. How much margin of safety is enough? The required margin of safety should vary with the uncertainty of your analysis and the quality of the business. For a high-quality business with a wide moat, highly predictable cash flows, excellent management, and a long track record of consistent performance, a margin of safety of 15 to 20% above the conservative intrinsic value estimate may be sufficient. The lower requirement is justified by the lower uncertainty in the analysis. These businesses tend to produce results that are close to what thoughtful analysts project because their competitive advantages and predictable earnings make them more forecastable than most. For a less predictable business, a business operating in a rapidly changing competitive environment, or a business with more leverage or operational complexity, a higher margin of safety is appropriate. 30 to 40%, or even more, may be needed before the risk-reward balance justifies investment. The higher required margin of safety reflects the higher probability that the intrinsic value estimate will prove significantly incorrect. For turnaround situations, deeply cyclical businesses, or businesses facing genuine existential competitive threats, the required margin of safety should be very high indeed, because the range of possible outcomes is extremely wide. In these situations, even a large apparent discount to estimated intrinsic value may not be sufficient protection if the downside scenario is severe enough. The patience required for margin of safety discipline. Here is where margin of safety discipline becomes genuinely challenging. Because great businesses at meaningful discounts to intrinsic value are not common, and the market does not provide them on demand. They appear sporadically, created by temporary investor pessimism, market-wide panic, industry-specific concerns that prove overblown, or company-specific challenges that turn out to be temporary rather than permanent. This means that the investor who insists on an adequate margin of safety before purchasing will spend long periods of time watching the companies on their watch list trade at prices that are either roughly fair or clearly expensive. These periods can be psychologically difficult. The market is rising. Everyone else seems to be making money. The stocks on your watch list are going up, but they are going up without you because they have not yet offered the discount to intrinsic value that your criteria require. The undisciplined investor eventually capitulates. They lower their standards. They tell themselves that a great business deserves to be owned at any price. They buy at prices that do not offer margin of safety because they cannot bear to watch the stock rise further without participating. The disciplined investor holds firm. They know from experience and from the historical evidence that great businesses regularly become available at discounts during periods of market stress. They know that buying without margin of safety means they are depending on good luck rather than good analysis for their returns. And they know that the discipline to wait will eventually be rewarded by opportunities that meet their criteria. This patience, this willingness to hold cash and wait for opportunities that meet your standards rather than forcing investments where the required margin does not exist, is one of the most genuinely difficult skills in all of investing. And it is also one of the most important. Market conditions and margin of safety. The margin of safety required for any specific investment must be understood in the context of overall market conditions. During periods of broad market overvaluation, when the average stock in the market is trading well above reasonable estimates of intrinsic value, it becomes much harder to find individual stocks that meet your margin of safety criteria. This is not an accident. It is the natural result of rising prices reducing the available discount to intrinsic value across most of the market. In these periods, the right response is not to lower your standards, but to be more patient and potentially hold more cash than usual. Holding cash is not a neutral or passive decision. It is an active choice to wait for better opportunities rather than deploying capital in situations that do not meet your criteria. Great investors have held large cash positions for extended periods, sometimes years, waiting for conditions to create the opportunities their process requires. Conversely, during periods of broad market decline and panic, extraordinary margin of safety opportunities appear with unusual frequency. When fear dominates the market and selling is indiscriminate, high-quality businesses often fall to prices that represent dramatic discounts to reasonable intrinsic value estimates. These are the moments when the disciplined investor, who has done the research in advance and has capital ready to deploy, can make some of their best investments. Be prepared for these moments. Maintain your watch list. Continue your research even when prices are high. Know which businesses you would want to own at the right price. And when the market provides those prices, act with appropriate decisiveness. Margin of safety and position sizing. Margin of safety also has implications for how much of your portfolio to allocate to any single investment. The larger the margin of safety, the more confident you can be in the investment, and the larger the position size that is justified. The smaller the margin of safety, the less certainty you have, and the smaller the appropriate position size. A stock with a 40% margin of safety, where you have high conviction in your intrinsic value estimate and the business quality is excellent, might justify a 5 to 10% position in your portfolio. A stock with a 20% margin of safety, where there is more uncertainty in the analysis, might justify only a 2 to 4% position. This graduated approach to position sizing, calibrated to the margin of safety and conviction level, is a form of risk management that systematically protects your portfolio. Never concentrate your entire portfolio in a single investment, regardless of how large the apparent margin of safety. No matter how thorough your analysis, humility requires acknowledging that you can be wrong. Portfolio concentration, without diversification, amplifies the impact of analytical errors. A diversified portfolio of 8 to 20 well-analyzed positions, each with meaningful margin of safety, provides both the concentration needed for meaningful impact from your best ideas and the diversification needed to survive your inevitable mistakes. Chapter 9. Make the final investment decision, bringing it all together with clarity and conviction. You have completed 8 steps of the most thorough, most systematic, most disciplined process that any individual investor can bring to the analysis of a stock. You have defined your strategy. You have filtered the market and built a watch list. You have studied the business model in depth. You have analyzed the financial statements over many years. You have assessed the competitive advantages and the durability of the economic moat. You have evaluated the integrity, competence, and capital allocation skill of management. You have estimated intrinsic value from multiple angles and defined your range with honest uncertainty. And you have calculated your margin of safety relative to the current market price. Now comes the decision. This is the moment that the entire system has been building toward. And while it might seem that 9 steps of thorough analysis should make this moment feel obvious and simple, the reality is that making a final investment decision still requires judgment, still involves uncertainty, and still demands the kind of intellectual courage that no checklist can fully replace. This chapter is going to guide you through the process of integrating everything you have learned and making a clear, rational, documented investment decision. The investment thesis, your case for ownership. Before making any final investment decision, write out your investment thesis. Not mentally, literally, write it down. Your investment thesis is a clear, concise statement of why you believe this particular business, at this particular price, is an excellent long-term investment. It should cover 5 essential elements. First, describe the business and why you understand it. What does the company do? How does it make money? Why is the business model compelling and sustainable? Second, articulate the competitive advantage. What is the economic moat? What makes this business genuinely difficult to compete with? How wide and durable is the moat, and is it widening or narrowing? Third, describe the management quality. Why do you trust and respect the people running this business? What evidence supports your positive assessment of their integrity, competence, and capital allocation skill? Fourth, summarize the financial case. What do the financials tell you about the quality and trajectory of this business? Is the business genuinely excellent by the financial measures you analyzed in Chapter 4? Fifth, state the valuation case. What is your estimate of intrinsic value and your range of estimates? What is the current market price? What is your margin of safety? Why is this price an opportunity rather than a fair price or an expensive one? This written thesis serves two powerful functions. First, it forces you to be specific and honest about your reasoning. Vague enthusiasm for a company is not an investment thesis. A clear, specific, evidence-based case for ownership that can withstand critical scrutiny is an investment thesis. Writing it down forces you to be specific rather than vague. Second, it gives you something to measure reality against as time passes. After you invest, the business will continue to report results, and those results will either confirm or challenge the assumptions in your thesis. If results confirm the thesis, you should generally hold and possibly add to the position. If results begin to challenge the thesis, you need to honestly evaluate whether the thesis is wrong, whether the story has changed, and whether the investment still makes sense. Many of the worst holding decisions in investing come from investors who bought a stock for good reasons, watched the thesis begin to deteriorate, but could not bring themselves to sell because they had become emotionally attached to the position. Having a written thesis with specific assumptions makes it much easier to recognize when those assumptions are no longer holding true, because you are comparing reality to a documented standard rather than to a vague memory of why you were excited about it originally. The red line questions. Final checks before commitment. Before making the final decision to invest, ask yourself 5 red line questions. These are the questions that, if answered negatively, should cause you to step back, regardless of how attractive the investment otherwise appears. Red line. Question 1. Do you genuinely understand this business well enough to be confident in your intrinsic value estimate? Or are there important aspects of the business model, competitive dynamics, or financial structure that you do not fully understand? If there are significant areas of uncertainty that you cannot resolve through research, admit it. Either continue researching until you have adequate understanding or pass on this investment. Investing in businesses you do not understand, even businesses that look attractive by quantitative measures, is one of the most reliable paths to poor long-term results. Red line. Question 2. Is the management team demonstrably trustworthy and competent? If you have any serious, evidence-based concerns about the integrity of management, this is typically a disqualifying factor, regardless of how attractive everything else looks. Dishonest management can destroy even the best business, and you will often not see the destruction coming until significant damage has already been done. Red line question 3. Is the business genuinely protected by a durable competitive advantage, or does it merely appear strong because conditions have recently been favorable? It is easy to confuse a temporarily favorable environment with structural competitive advantage. Airlines look like great businesses during economic booms and terrible ones during downturns. Commodity producers look fabulous when commodity prices are high and devastating when they fall. Make sure you are buying a genuinely advantaged business, not just one riding a favorable economic wave. Red line question 4. Is the margin of safety genuine and adequate for the uncertainty in your analysis? Have you been honest about the uncertainty in your intrinsic value estimate? Or have you used optimistic assumptions that artificially inflate the estimated intrinsic value and make the margin of safety look larger than it truly is? Intellectual honesty here is critical. An artificially computed margin of safety is no margin of safety at all. Red line question 5. Does this investment fit your investment strategy as defined in Chapter 1? Is the time horizon appropriate? Is the risk level consistent with your risk tolerance? Is the type of business consistent with your areas of understanding and expertise? Sometimes, an investment opportunity that is genuinely excellent does not fit your specific strategy, and that is perfectly acceptable. Your strategy is your strategy for good reasons, and preserving its integrity requires the discipline to sometimes pass on investments that might be excellent for someone else but are not right for you. If all 5 red line questions are answered with a confident yes, proceed. Sizing the position. How much to invest? Assuming the final decision is to invest, you now need to determine how much capital to allocate. Position sizing is one of the most underappreciated skills in portfolio management. The amount you invest in any single position reflects your level of conviction and the magnitude of the margin of safety. Higher conviction plus larger margin of safety equals larger position size. Lower conviction plus smaller margin of safety equals smaller position size. As a practical framework, consider dividing your positions into three categories. High conviction positions, where you have the deepest understanding of the business, the highest confidence in your intrinsic value estimate, and the largest margin of safety, might receive 3 to 5% of portfolio value at initiation. Over time, as the thesis plays out and confidence grows, these positions might grow to 5 to 10% of the portfolio. Medium conviction positions, where the case is strong, but where there is more analytical uncertainty or a somewhat smaller margin of safety, might receive 2 to 3% at initiation, with the potential to add if the thesis strengthens. Lower conviction positions, which you include because the potential opportunity is interesting, but where uncertainty is higher, might receive 1 to 2%. These are positions where you are establishing a small stake to keep you actively engaged with the research, not concentrating capital in a situation where your confidence is limited. Avoid the temptation to make every position the same size. Equal weighting implies equal conviction, and you almost never have equal conviction in all your ideas. Let your conviction level, guided honestly by the quality of your analysis and the magnitude of your margin of safety, determine your position sizes. The decision not to invest. Equally important. The final investment decision is sometimes the decision not to invest. And this decision is every bit as important as the decision to invest, perhaps more so. Passing on an investment is not a failure of the process. It is the process working correctly. If a company fails one of the 9 steps, if the business model is unclear, if the financial history is concerning, if the moat is narrow or uncertain, if management has integrity questions, if intrinsic value is impossible to estimate with reasonable confidence, or if the margin of safety is insufficient, the right answer is to pass. There will always be more opportunities. The stock market is a continuous source of new investment ideas and recurring opportunities in businesses already on your watch list. The discipline to say no when the 9-step criteria are not met is what keeps the portfolio strong and the returns compounding over time. Every weak position you avoid is as valuable as every strong position you make. The investor who maintains strict criteria and passes on many opportunities will, over time, hold a portfolio of positions in genuinely excellent businesses purchased at genuinely attractive prices. The investor who lowers their standards to stay busy will gradually accumulate mediocre positions that drag on overall returns and demand disproportionate attention during difficult periods. After the decision, monitoring and the sell framework. Once you have made the investment decision and established your position, your work is not done. Owning a stock requires ongoing monitoring of the business to ensure the thesis remains intact. Review your thesis regularly, ideally after each major earnings report and annually in a comprehensive reassessment. Ask yourself whether the business is performing in line with the assumptions embedded in your thesis. Is the moat holding up? Is management continuing to make good decisions? Are the financial metrics consistent with your expectations? The decision to sell should be driven by specific criteria, not by market price movements. Prices go up and down for all sorts of reasons that have nothing to do with the underlying business, and trading in and out based on price movements destroys the compounding power that makes long-term ownership in great businesses so valuable. Sell when the thesis has fundamentally changed. If the competitive moat is genuinely eroding due to technological disruption or competitive assault, if management integrity has been meaningfully compromised, if the financial situation has deteriorated in ways that suggest the business is in structural decline, These are reasons to reassess and potentially exit. Also sell when the price has risen so far above your estimate of intrinsic value that the margin of safety is not just gone, but replaced by a significant premium, suggesting that the market has become significantly overenthusiastic about the business. At that point, the balance of risk and return may favor using the capital elsewhere. And always hold when none of these conditions for selling are met. When the thesis is intact, when the business continues to compound its intrinsic value, and when the price is still reasonable relative to your estimate of value, the optimal action is often to do nothing, to let compounding work, to be patient. This is hard in practice because markets move constantly and the temptation to react is ever present. But the evidence is clear. Investors who trade less frequently tend to outperform those who trade more, controlling for strategy. The long view. What this system is really building. As we come to the end of Chapter 9 and to the end of the formal 9-step system, let us step back and appreciate what you have really built by working through this process. You have built an intellectual framework for understanding businesses, not just one business, any business you choose to study, the skills you have developed in analyzing business models, reading financial statements, assessing competitive advantages, evaluating management, and estimating intrinsic value will improve every year you apply them. The pattern recognition develops. The judgment sharpens. The circle of competence widens. You have built a decision-making system that protects you from the two most dangerous enemies of investment performance. Those enemies are impulsiveness and emotion. The 9-step system insists on thoroughness before action. It insists on evidence before conclusion. It insists on honesty about uncertainty. It creates a structure within which rational, well-grounded decisions can be made even when emotional pressures are at their most intense. You have built a standard of excellence that will continuously guide your portfolio toward positions in genuinely great businesses at genuinely attractive prices. That standard will keep you out of the hype, the speculation, the fashionable ideas that attract attention but destroy capital. And it will keep you focused on the patient, disciplined, evidence-based ownership of excellent businesses that is the surest path to long-term wealth creation through stocks. The investor you are becoming. Let us return to the image we began with in the introduction. The investor who never guesses. The investor who works through a checklist while others chase headlines. The investor who holds positions calmly through market volatility because they know what they own and why they own it. The investor who is boring to watch, but extraordinary to emulate. That investor is who you are becoming by learning and applying this system. The transformation does not happen overnight. It happens through application. Through actually working the 9 steps on real companies. Through making decisions and observing what happens. Through the inevitable mistakes that every investor makes and the lessons those mistakes teach. Through the patience required to wait for opportunities that meet your standards. Through the discipline to hold excellent positions even when the market is creating fear and the urge to sell is strong. But the transformation happens. And when it does, you will experience something that the undisciplined majority of market participants never experience. You will experience the calm confidence of an investor who truly understands what they own, why they own it, what it is worth, and how much protection they have built into each position. You will experience the quiet satisfaction of watching great businesses compound your wealth over years and decades, turning patient, disciplined ownership into extraordinary, long-term results. This is what the 9-step system is ultimately about. Not finding the next hot stock, not beating the market in any given quarter or year, but building the knowledge, the judgment, the process, and the discipline to be an excellent investor consistently over a very long time. An investor who never guesses. An investor who always has a reason grounded in evidence and logic for every position in their portfolio. Closing reflection. The system in practice. Before we part, let us briefly revisit the 9 steps one final time, not as a list of tasks to complete, but as a description of how an excellent investor thinks about every potential investment. The excellent investor begins with self-knowledge. They know what they are trying to accomplish, what risks they can genuinely tolerate, and what kinds of businesses they are equipped to understand. This strategy clarity guides everything that follows. From that clarity, they filter the vast universe of investment opportunities down to a manageable watch list of genuine candidates, not by being hasty or superficial, but by applying clear, consistent criteria that match their strategy. From the watch list, they go deep on individual businesses. They read widely and deeply about what the business does, who its customers are, why those customers choose it, and what protects it from competition. They understand the business the way a thoughtful owner would understand it. They then examine the financials with patience and analytical rigor, looking not just at the current numbers, but at the trends, the quality of earnings, and the historical consistency that reveals the true economic character of the business. They assess the competitive moat with both evidence and imagination, asking not just whether the advantage exists today, but whether it is likely to persist and perhaps strengthen in the future. They evaluate the management team through a combination of track record analysis and qualitative assessment of character, always asking whether these are the people they want to trust with their capital for the next decade. They estimate intrinsic value with appropriate humility, building a range of estimates rather than a false, precise point, and grounding every assumption in evidence rather than optimism. They calculate the margin of safety with honesty, using their conservative intrinsic value estimate and insisting on a meaningful discount to that conservative estimate before committing capital. And they make the final decision with the intellectual courage to either act decisively when all 9 steps are satisfied or to pass without regret when they are not. This is the complete system. 9 steps, each one essential, each one connected to every other. A process that any investor can learn, apply, and improve over a lifetime. The market will always be there. The opportunities will keep coming. And the investor who works this system faithfully will be ready for those opportunities when they arrive, armed with knowledge, equipped with judgment, guided by process, and protected by discipline. That investor, over time, will do something remarkable. They will turn the chaos of the stock market, with all its noise and volatility and irrational behavior, into a reliable engine of long-term wealth creation. And they will do it not by being the smartest person in the room, not by having access to special information, not by taking excessive risks, but by being the most systematic, the most disciplined, the most patient, and the most honest person in the room. That is the power of the 9-step stock analysis system. And now, it belongs to you. Go do the work. Trust the process. And invest well.